So I'm Omi, CTO at Fragment, and we make double entry ledgers as an API. Our ledgers are designed to sit between the app and the bank so that you can account for payments as you make them. So we've usually had single entry ledgers, and they've been working pretty well, even though we live in inherently multi-currency world. And it hasn't really been a problem till now, because you've had basically humans in between those ledgers smoothing things over, and you haven't needed to answer those questions in real time. As long as you get the answer by the end of the month or the quarter, you're doing pretty well. But things are changing, because even startups or small businesses have the same problems as multinationals, because being remote means being global. We expect our fintech super apps to not just do our banking, but our stocks and crypto, even private investments, as they become more liquid. And thinking more globally, we're going from a sort of single superpower to a multipolar world. That's going to mean we're going to have multiple reserve currencies. All these different types of value are going to become more volatile, because the world is going to become more complex. And that means we need to know what's happening with all of our currencies in real time. So that sounds pretty intimidating, right? We're the ones who are supposed to solve all of these issues. And hopefully we can take the first step to actually doing that. So we're going to go on a bit of a journey. We're going to go through the history of value, and alongside each sort of era, we're going to be looking at the data structure that tracks the type of money we had in that era. We're going to go from single entry, which is probably the easiest way to track it when you have a bartering economy. Then we'll have the introduction of money, and that's going to lead to double entry, which is sort of where we are today. And then as you go forward and you're dealing with multiple currencies and multiple types of value, the ledger that works for that basically implements double entry bartering. So who here has experience with double entry accounting and can do it in their sleep? That's a good number of you.
You had to sleep. I had to get out of it.
Okay. I think that's where we sort of need to go, right? If you're going to be a fintech engineer, this is our domain. It's the data structure for money, and we really have to know it. Now we're going to be going through sort of primer in double entry, and we're going to build it up slowly. So hopefully everyone can catch up. But ideally, you would have a night of sleep between the first and second half of my slides, so that you can process this stuff. But otherwise, let's see how it goes. All right. So here's a logical representation of a ledger. And we're going to go through each step. But the thing just to sort of realize here is that each step, we're adding sort of another dimension to our data structure and a new type of balancing, right? And it's sort of, by the end, a lot, but it's actually quite beautiful how it all sort of comes together. So let's start at the beginning with single entry. And we're going to go through a use case, sort of like Ledgers of Catan, where in this bartering economy, you're a farmer and a miner comes along and says, hey, you have some grain, I'd like you to swap it for some ore I have. What's the data structure for that look like? There you go. So here's a ledger. It's single entry, and a ledger is basically a set of accounts. Those accounts are the columns here. They have a balance, so the farmer starts off with no ore and 30 grain, and those balances change, and those changes are called lines. When those lines happen, they are grouped together, because their swap is sort of a two-way process, represented by two numbers, and that whole operation together is sort of like a database transaction. As you can see here, we're swapping 5 grain for 10 ore, and so at the end, we end up with 5 grain and 20 ore. Make sense so far? Cool. So now things are going to go a little bit off the rails, right? Now you're a farmer. The miner comes along and says, I've got some ore, do you have some grain? And you're like, actually, I haven't harvested my grain yet. But I can take that ore, swap it for some tools, harvest my grain, and then I'll give it back to you. And so now we need to deal with hypothetical grain and extend our data structure to be able to handle that type of value. So there you go. So now, instead of having the one operation just to do a swap, we have 3 operations. First, we record the fact that we did the swap for ore for future grain. Then we harvest our grain, record that in the ledger, and then we record the fact that we paid off the grain that we owed. So we still have the same columns as before, but the third column is a new type of column. Previously, we had columns that represented things that we have. Those are called asset accounts. And now we have got this new red column with an L, which stands for liability, and that's now recording things that we owe. So now the ledger isn't just representing value that exists, value that could exist. And only value that could exist, value that's anti-value, right? It's value that someone else has an obligation on us on. You can imagine that the miner, if they had a ledger in their heads, would have a similar sort of structure going on, except for them, the future grain isn't something they owe, but they are owed. And that's going to be done using the same type of asset account. This data structure doesn't actually differentiate between things you have and things you will have. And that's a key point, because that's actually how money works, right? The money that we have in our pockets, in our bank account, isn't value we have, it's value that we can swap, in theory, for goods and services in the future. So the starting and ending balances are the same. Right? We started off with nothing, and now we still have 5 grain and 20 ore, but we've got some interesting things going on in between. I want to just zoom in on the balance of this ledger. This makes sense. At the end, we have 5 ore and 20 grain. But we think of balances as a single number. And we sort of, when the money got introduced, we lost this idea of multi-currency. But this format is going to come back once we go to a multi-currency ledger. Now, the problem with a single entry ledger is that we can now record what we had at the beginning, what we had at the end, how that changed, but not record why it changed. In the beginning, this might not be much of an issue. You're just trying to get by as a farmer. But if you have a more sort of sophisticated enterprise where you're like a merchant, things are coming in and out, and you're making profits, or the government becomes really interested in what's the source of your change, because we're going to tax that differently. Now you have to have a much more granular tracking of not just what changed, but why. And that's where double entry ledgers come in. And so what we looked at was the first layer in this block, which is called the state layer. And that basically tracks the current state of your finances. We need to add another layer, and that's going to be tracking why the state layer changed. That's the change layer. We're going to be adding new types of accounts to sort of do that in a granular way, and we're going to go through more examples. So now the farmer has advanced in his board game and is now living in an era where money has been invented, and he can simply go buy some ore. And so we're going to be looking at both the buyer's perspective, the farmer, and the seller's perspective on that same transaction. So here you can see that a couple of things have happened. We've still got ledgers, we've got accounts, but now we've got 2 layers. We've also switched from dealing with the items directly, ore and grain, and we're now recording them in terms of their value, in terms of money. So what's happened here is we've bought some ore for $55. We actually only got $50 worth of ore, which means the net change to our wealth has been $5. And that's what we need to record in this second layer and actually say why it changed. And we do that by putting it into a specific account. And here it's called a tax account. And these yellow accounts are called expense accounts. And they record why you have a negative amount of change happening to your net worth. On the other side, we can look at what happens for that same transaction on the buyer side, on the seller side. So the same $55 gets transferred. That's the first column, except now it's a plus 55. But to us, the ore is only worth $30. Maybe that's what we bought it for, or it's how much it cost us to extract that ore. And so the difference between there is now $25. When we charge tax, that tax isn't money that we have. and we didn't earn it. We actually now owe it to the government. So we're using a liability account to track those $5 in tax. So previously, this $5 lived in the change layer, but for the seller, it lives in the state layer because it's a liability. Now, if you add up all that stuff in the state layer, the $55 minus 30 minus 5, you end up with $20, and that has to be balanced in the change side. And we're using the blue account here. And these blue accounts are called income accounts, and we use those to record why our state layer went up in value. And that's pretty much double entry. This is what accountants sort of learn to do, and once they learn the data structure, what they're really learning for the next however many years is all the different rules that apply on top of that data structure, the business logic on top of this database. Now, hopefully that's had time to absorb, because we're going to add a third dimension. And what we're going to do is see how double entry happens per currency, because we have two problems now. There you go. We still want the ledger to balance. Right? This double entry mechanism was really useful for tracking things in a granular way. But the problem is that, the example we're going to go through is, the farmer is now in the modern age, and he's buying stocks and shares. And so he's going to buy a Tesla share for $1,000. Now, to balance those numbers, that makes sense conceptually. A Tesla is $1,000. That's the same number. But mathematically, they're just different numbers, and they're different units. So how are we going to balance them? The second problem is the exchange rates. Right? We have to be tracking the fact that the exchange rate is going up and down, that there is one, and so we need to extend our data structure to be able to do that. So, anyone have any ideas how we do that? Actually, the answer is pretty interesting. Those two problems are the solutions for each other. The way that we balance the ledger is that we balance it by tracking the exchange rate. That's pretty nice. So we can see how that works. Oh, there you go. So here's the example. It's pretty simple. We're going to buy a share in Tesla. Price is going to change. And then we're going to sell that share in Tesla. And that means that in the state layer, we're going to have a change in the starting and ending balance. And that's going to have to be balanced somehow. So you can see here on the asset side, if you focus on that, we've got two accounts now, one for USD and one for Tesla. And it looks pretty much the same as the first example, where we had $1,000 and we spent it on one Tesla. And then later on, we sold that one Tesla and swapped it back for $1,100. And that makes sense. And then what we've introduced is two new types of income accounts. And together, they are balancing out just mathematically what's happening in the state side. If you have $1,000 on the green side, you have to have $1,000 on the blue side. So, and the ledger is sort of doing what it's supposed to be doing. Oh, there you go. At the end, the balances sort of tell the story. We have $1,100 at the end, when we had $1,000 at the beginning, and this income account is saying, this is where the $100 came from. But what does that actually mean, and how does that work? Right? The state layer makes sense. After we bought the share, it says you've got no dollars left, and you have one Tesla share. And the change balance looks really kind of weird. It's saying minus 1,000 plus one Tesla. So balances have gone from being numbers back into equations. And that's what we call them, balance equations. And the way to think about it is that the solution to the balance equation is going to be your gain or loss because of the changes in exchange rates. So we can go through and see how that works. First, we can do a sanity check. What happens if the price didn't change, right? The price of a Tesla is still $1,000. So we just substitute in that $1,000 into this equation, they cancel out, and it ends up at 0. That makes sense. We didn't make any money because the price didn't change. But if the price went up, the minus 1,000 plus the new price plus 1,100 it leaves us with $100. And that means we made $100 because the price went up by $100. That makes sense. Same thing if the price goes down. We have $900 for a Tesla. We spent $1,000, and so substitute it in, solve the equation, and you get minus $100. So that's working in a sort of really, in a simple example. The key point is that this system scales, right? If we had bought Tesla shares at different prices, we ended up with like 5 Tesla shares, all at different prices. The change equation would have been updated each time that we bought a share. And it's also now tracking what's the total amount that we spent on Tesla shares. And it's sort of tracking the average share price that we changed, that we paid. And so if the share price that currently goes above or below the average price that we paid, then we've made gain, or if it goes below, we've made a loss. This also scales to any number of currencies. Here we have only 2 currencies, and so we can sort of do this sort of thing in our heads. But when you implement the data structure, and we're going to go through this example next, what happens if we add more and more currencies to this? The rules work the exact same way, but it's now actually doing a lot of work for us. So here's a new example. The farmer has discovered Wall Street bets, and he has an amazing strategy. He's going to buy a share in Tesla, but his heard hedging is a great idea. So he's also going to buy 2 shares in BP, but BP is a British company, so he needs to pay for those in pounds. And he's going to make his trades, and then at the end, liquidate everything back into USD for his gains. So here are the 6 ledger entries that we need to do. Right? We're going to buy some Tesla, buy some pounds, use those pounds to buy shares in BP. Then we're going to sell the BP shares, convert the pounds back to dollars, sell the Tesla shares, and hopefully we'll end up with a nice big profit. And you can see here we're starting off in this little diagram with 1 currency. We explode out to having like 4 currencies that we're dealing with, and then we liquidate back down to 1 currency. And things are going to get pretty gnarly here, but it's just the same thing being applied over and over again. So let's look at the first 3 entries. So now we've got a few more accounts, right? Now we have 2 sets of accounts for both, on the asset side, our cash and our stocks, and they're all in different currencies. And instead of having 1 set of accounts for tracking the exposure, we have an exposure account for every currency pair. And with the entries, they're kind of doing the same thing as before, right? We have $1,000 that we spent to buy a Tesla share, and that's being balanced on the other side of the ledger by $1,000 and plus 1 share. And so each entry is doing the same thing, but it's being balanced by the exposure account for its own currency pair. Now let's look at the balance equations after we've bought the shares. These are kind of a mess, but once we simplify everything down, they start to make sense. After we buy everything, we own 1 Tesla share and 2 BPs. That makes sense. And the change account, the exposure that we have, is minus 2,000 plus 1 Tesla plus 2 BP, which means as long as the combined price of Tesla and BP is above the amount that we spent on it, we've made a gain, and as long as it's below, we've made a loss. But we've also now got components of exactly where that gain or loss came from, because we've got an exposure account per currency. So let's see how it happens when we sell, right? So again, same thing is happening mathematically, but now we have different numbers because the prices have changed. In this first entry, we sell our shares in BP, that's the minus 2, but we get £875 for it, even though we paid £25. So we paid $850 and we made £25 on it. Then when we convert those pounds, back into dollars, we get $1,050. That's in the cash account. And on the exposure side, we're just reversing what we just happened, right? Where the exposure went up and then went down again. Because as we exit out of that position, our exposure reduces. And what's left in the exposure accounts at the end is sort of the net change between all of our activity. So after we're doing all this, we've got $2,150 in our account, even though we started off with 2,000. And then if we go look at the balances, there we go. You can start to see what's happening here, right? Each of these sections in the change balance is explaining and breaking down the 150 net difference. First, we can see that we made $100 from Tesla, and that we made £25 from BP. And what that £25 is worth $50. That's what the first exposure account is telling us. So things are going to get even more gnarly. Just going to check in with everybody here and make sure that's all making sense. Cool. Nodding heads. We're doing pretty well. Right. We actually did it wrong. I'm sorry. There's a problem here. There's a sleight of hand. But if you go back to this entry, when we sold those pounds, the exchange rate actually changed on us, and our ledger is sort of hiding that fact from us, right? And that's because we've grouped together the change that happened in the BP shares and the change that happened in the pounds to dollars exchange rate. For some use cases, that's actually completely fine. If you don't actually care where that gain came from, you just care that I did some stuff with BP, some stuff happened along the way. I just care that the net change across all that stuff was $50. But a lot of times, tax authorities do care. You're going to pay a different tax rate based on whether it was a gain due to the exchange rate changing or a gain due to the share price changing. And so we need to now figure out how we're going to track these things in a more granular way. Now, exactly how you do that is why you go and become an accountant, because the rules are different depending on what country you're in, what geography, what country the entity that's trading is in, what actual assets are happening. If you've heard about FIFO and LIFO and average cost basis in stocks, these are all basically the different rules of how you deal with this situation. So we're going to be covering just the simplest one, just to see how it works. But this is definitely an illegal way to do it in some countries. So don't take this as legal advice. But it'll show you the overall big picture. So we've actually now focusing just on the change layer. The state layer looks the same as before. And what we've done is taken the exposure accounts and basically introduced a pipeline, right? Where as we process these payments, we're moving money into exposure as we get exposure. And then as we move out of these accounts, we're moving them to what's called an unrealized pipeline, which is we don't have exposure anymore, but we now have a gain or loss that isn't in the currency that we care about. And then the last step of the process is this set of accounts called realized accounts. And that's as we exit out of positions into our home currency, the pipeline moves the money from unrealized to realized. I've sort of split the first entry into two. And this first one looks the same as before, which is that we sold 2 shares of BP and we got £875 for it. But when we exited out of that position, we made a net gain of £25. And so the next little section moves that money out of the exposure account because we are no longer exposed to it into a different account that's tracking why we made that gain. And this is saying we made that gain because of capital gains in BP in pounds. Now the question becomes sort of philosophical at this point is, so we definitely made £25 when we made BP, when we sold the shares in BP, but what's that worth in dollars? Should we use the exchange rate on that day? Should we use the exchange rate of the dollars pounds that we have bought so far? Or should we just leave it there until we actually convert it back into dollars, and then we know what it was worth to us, actually? And again, the answer there depends on if you're a subsidiary, if you're a partnership, what the rules are, what the AICPA says, lots of different ways to do it. In this example, we're trying to treat it in sort of the purest way, which is that we made £25, and £25 is £25 until it turns into dollars. So we're just going to leave it there. And so you've got, every time you're exiting out of a position and selling, you're realizing that exposure, right? You're saying, all right, here's how much I'm not exposed for. Anything that's left over, I have to say where it should move to so I can deal with it in the next stage of the pipeline. And so when we sell our pounds, the first entry again looks the same, where we sold £875 for $1,050. Now this realization line is kind of interesting because we made an extra £25 that we have to account for, and we got 50 extra dollars. And so some of that is going to be because we converted more money, and some of that is because the money that we're converting changed exchange rates. And so we need to split those apart when we do that, and that's happening in that third line. So what's happening is we put the capital gains that we made on BP, that £25, and we're saying, all right, we're dealing with this now. It's going away. And it's moving into the realized capital gains for BP bucket, which is at $29.41. Right? So £25 has turned into $29.41. And so where did that number come from? Well, this is the exchange rate of all of the dollars and pounds that we've bought so far. That's why this is called the average cost basis method. Where we're saying, okay, if there is no exchange rate change, right, the amount that we're selling our pounds for is the same rate that we've always been buying our pounds for, we should have no forex gain or loss. But since we do, we use the exchange rate that we've had so far to record all the activity that we've had so far. And then we sell those pounds and we get some dollars. And any difference between what the gain would have been at our old exchange rate and what the gain actually is with the new exchange rate, we add in that last account. And so that $50 extra we got is now being split into the $29.41 and the $20.59. So that's a lot. We take a check in there. It's less important you sort of understand the exact maths, right? Because all these methods are going to be different. The more important thing is that we have basically a data pipeline where we're moving things from exposure to unrealized to realized. And this pipeline is going to get more complicated. The more stages you have, the more currencies you're dealing with. And if you're dealing with, like here, we are exiting out of all of our positions 100%. What happens if we only sell one share and exit out of that, right? How do we account for that? These are sort of more complications that get added on, but the overall picture looks the same. And I'm not sure if anyone has taught accountants about data pipelines, but that's how we're going to need to deal with them as we sort of go forward. So here's the answer in the back of the textbook. We did all this activity, and how much did we make? Well, we made $150, and that's split into $100 we made from Tesla, $29.41 we made from the BP shares, and the $20.59 we made because the currency rate changed in our favor. Cool. Well, that's as gnarly as it's going to get for today. Here is like the full answer. We're not going to go through this, but like this is everything that we've been through today, just sort of split out. And my designer was just like, dude, there's no way I can put everything on screen. So the entry names are cut off, but here is like the whole picture. And this is pretty complicated, right? We have to figure out how to do this. There's multiple currency rates, multiple exchange rates, reporting and regulations on top. We haven't talked about payments and integrations and reconciliation and fraud and all the other things we need to do that make fintech hard. But there's also an opportunity here. it's kind of weird when you think about it, that all of our money systems only deal with one half of a trade. They only deal with the money. Think how much simpler like a retailer system would be if their money system and the stock keeping system use the same source of truth, because that's what's being swapped. Or a company that pays its workers by the hour stored those hours alongside its payments, right? Once we have ledgers that can store multiple types of value, we can upgrade the payment rails between them to communicate multiple types of value. I think it's the only way we can actually handle all of this complexity that's coming, is that we need to have better abstractions that sort of simplify and unify concepts and the systems underneath them, just so that we can reason about them in our heads. Right? It's what we do as engineers, is to come up with better data structures, abstract away some of the complexity, and then deal with that new, more interesting abstraction in a simple way. So when you put all these types of value together, what I'm basically saying is, we've all been talking about embedding finance into everything. Maybe we should start thinking about embedding everything into finance. There you go. So I'm always clearly ready to talk about ledgers. So you can hit me up on email or LinkedIn. And I think we have some time for questions. So yeah, go ahead. People are thinking, I can see.
I'm thinking about, so I'm thinking about what you just said at the end about embedding stuff in the transactions. We have a system that issues loans for myriad types of assets, like N types of assets,
Mm-hmm.
right? So how do you deal with a system that has N number of currencies and not a fixed number of currencies?
Yeah, I mean, it basically just becomes basically an engineering challenge, right? You just have to look at what's the data structure I need to implement and figure out how do you make a scalable database layer that can store all this stuff? How do I have a compute layer that can compute all of these aggregations? Hardest problem when implementing all this stuff is the aggregations, actually, right? Because you can store all of these accounts in all these different values, and that looks like the same type of ledger. But now when you're aggregating them, you have to figure out what are all of the accounts in the same currency and pool those together, and you might have thousands of millions of accounts and millions of currencies. Financial data actually isn't that big though, right? We are like orders of magnitude below clickstream data or real-time market data. And so aggregation pipelines were built for those type of systems. And so actually, until you get to Stripe scale, building a system that can handle all of this data isn't the hard part. The hard part is making sure you're doing it right and you're granular enough with trying to build a system that does that. And the other part of it is, the real problem I think I said is, how do we build the right abstraction to let us reason about these things in a way that our code doesn't look like a mess and we can whiteboard things in a sort of reasonable way. Yeah.
Kind of regulate the scaling of your, you represented USD multiple times in multiple accounts with exposure accounts.
Yeah.
Does that mean ultimately now you have to an n squared number of accounts you want to represent them separately for every pair of currencies? Especially the dynamic situation, how n squared problem is pretty rough.
Yeah, so I remember that. I need to repeat questions. So the question was, now that we have lots of granular accounts, do we have like an n squared problem because we're tracking each currency multiple ways? Yes, you do, right? And what I showed you was a simple exposure account where we just have one exposure account for every currency pair. But in lots of situations, you actually need even more granular currency than that, where if you have different trading partners, you probably want to track the prices you're paying per currency partner. Or if you do a platform on behalf of doing things for other users, you need to break those accounts down by other users. And that's why the aggregation problem sort of gets wider. And it is a different type of problem because you're not just dealing with sort of more and more data horizontally, or more and more sort of columns horizontally. Right? You're trying to get more different types of data added together, not just more data of the same type. And so your aggregation pipeline needs to understand the hierarchy of those accounts. You can't just give it this massive wide thing and expect it to be performant. you need to match the pipeline to the shape of your data, which is, this is a hierarchy. You only need to care about this section, then this section, and this section, and then those aggregate up, and then you only care about this section, and that section, and that section. So it's really important to have sort of probably like a streaming and more flexible aggregation pipeline versus batch one, which is what most financial systems use today. Yeah, at the back.
Yeah. Seems like you made a deliberate choice to use like positive and negative as opposed to debits and credits, and then similarly with like what you call state and change. What went into that decision, and how do you sort of like map, whether like receivable accounts is state or change?
Yeah. So the question was, some of this looks different than normal accounting. We use negative numbers, we use state and change, and what's behind that. I think for us, it's really about talking about these things in a way that engineers understand. We understand state and change between variables and state machine. Those are intuitive concepts to us. And so are negative numbers. Right? Double entry came about before negative numbers existed, and that's why they use credits and debits. But that means we're sort of leaving aside the intuition our brains have built around positive and negative. Or we'll be dealing with that all that life. And so when we're dealing with more complicated concepts, I think it's better to have a foundation that's more familiar to us as engineers, so that we can sort of dedicate the horsepower to thinking about the new thing instead of trying to just think about the old thing and the foundations.
So what's been a challenge in, I guess, confirming that your implementation is correct in the real world?
So
You probably have to talk to actual accountants.
yeah. Now this doesn't work any differently than accounting. We just renamed it, right? So the state layer is the balance sheet. The change layer is the income statement. And one of the reasons we have asset and liability and income expense accounts in this example is that starts to bridge sort of the engineering view to the accounting view. And I actually think they are a pretty good way to start thinking about how do I take this problem and model it. Right? You have more colors to model the problem because some other ledgers just use credits and debits and credit normal and debit normal, and that I think is like a bit too abstract, for us to like use it as a modeling language. So I think a good API and a good ledger gives you not just the ability to transact, but to reason about the money system. Okay, I think that's all the questions. I'll be here if you have any more.